Well, the next topic, the next session that really deliberates on is Beyond Silos, creating an integrated credit framework for tomorrow's financial ecosystem. Well, as we all know that the future of lending requires an integrated approach, breaking down silos and fostering collaborations across financial institutions. And in this session, we will explore how cross-sector data, interconnected credit ecosystems, and fintech collaborations can bridge the existing gaps. Ladies and gentlemen, please put your hands together. Joining us on stage is Mr. Gaurav Kumar, founder and chief executive officer at Yubi. Can we bring all that energy in and put our hands together louder, please? Thank you.
Hi, morning everyone. I'll try and keep it both brief as well as try and make it much more interesting, and would be great to have your questions. What I'm going to really talk about, there's a lot of, to my mind, buzz around over the last 2 odd weeks, right? The world has changed significantly. I think there has been a tectonic shift across technology. And what we are now seeing on Agentic AI, to my mind, is largely around engineering then data, right? And how do you move forward without even writing a single line of new code or training your models to get better and better with your customers, right? So what I'm going to focus on is largely 2 components. One, how do we move the entire ecosystem from static risk to dynamic risk, right? I think today the entire framework and ecosystem is around static risk. You are looking at customers when the customer needs money, or you are looking at a customer when a customer is actually at the verge of default, right? So how do you move that framework, which is largely static and was not possible to move it to a dynamic framework without, to my mind, data and AI? And second is collections, right? So your credit ecosystem will not deepen unless and until your collection ecosystem deepens significantly, right? So these are 2 parts to what I'll just focus on. So if you look at the very large part of the overall credit gap, right? I think we've been talking about it. There is a lot of new to bank, new to credit coming in. The key challenge again is the same, right? How do you actually access the customer, which is becoming more and more seamless? The customer today is sitting on multiple landing zones, right? The customer today is sitting on apps where they are actually transacting for food, for payment, for delivery, etc., right? So the customer is now no longer coming and sitting inside the bank, right? So if you look at the shift, last 10 years, the customer used to walk into a bank branch. From there, the customer moved to internet banking. And now the customer is actually not going to internet banking as frequently because the customer is largely transacting most of their payments, low ticket size payments via UPI, right? So what you will see more and more is that the customer is going to sit on very deeply embedded landing zones and not directly come to the bank through one channel, right? So your acceleration of customers coming into the banking system is going to get rapidly accelerated. Second, what you will see is it's already happened with advent of UPI, and now what you are seeing with AA, the ecosystem, the entire banking ecosystem as far as credit and underwriting is concerned, is actually moving from something which was, to my mind, low throughput, high latency, to very, very high throughput and low latency, right? So today, if you look at the core banking of banks, they are being hammered with millions and millions of transactions which are getting processed both on the payment side as well as on the lending side, right? So how do you see that playing out if you have to see a large number of customer base new to credit, right? Very, very challenging, and new to bank, right? So this, to my mind, is going to be extremely complex and challenging if you're not moving the credit underwriting and risk paradigm, including collections, right? So you will not see the credit market or the lending market deepen if structurally we are not solving for these 2, right? And that's going to be the core to my talk today. If you look at some parts, I covered. Largely, we have been talking about unavailability of organized data, collateral, etc. But I'll just give you one key point, right? So if you look at today, any form of credit, I'm just giving an example of a pain point of a very large bank today on SME, small corporate, mid corporate, large corporate, right? So this bank today has roughly 10,000 customers, right? Which means that if we really move to a dynamic credit framework, the bank has to actually rewrite the customer 50,000 times, right? 4 times mandatorily the customer is actually pushing data, which is quarterly information. In retail, you are getting access to information almost real time, right? Now, it is not humanly possible for any bank, any underwriting system to actually reassess, rewrite customers 50,000 times a year, right? So traditionally, what are we doing? We are saying we will actually segment risk. We will take 5% of the risk. What is the top 5% of the risk? And then start monitoring and managing that risk. But your default actually starts happening outside that 5%, and that's where the ecosystem starts reacting, right? Which means that your filtering is becoming tighter and tighter without really factoring in what is the factorial analysis and what is the real reason which is actually driving your credit loss, right? So we are constantly reacting because we are not in control of each and every credit which is sitting inside the ecosystem, right? Now, some of this, to my mind, as I said, you will see a rapid change. You will start seeing more and more new to credit and new to bank coming in through different landing zones, right? I think, to my mind, it is going to become almost like an operating system. And one thing which is not going to change next 10, 15, 20 years is the customer will still get credit through a loan, right? So, in fact, I'm just provocating and saying even an invoice is a loan, right? A securitization transaction is also a loan. Any security is also a loan, right? So if a customer is actually accessing any form of credit, the instrument is largely going to be a loan, right? Now, keeping that framework in mind, if the customer is now coming in from various landing zones, how do you really embed data? And then how do you embed on top of that your ability to assess, rewrite, and constantly keep rewriting that customer, right? And keep calling various agents, which I will talk about, something which we have been building and implementing at scale now on the Agentic framework, both on underwriting and collections. And how do you call multiple agents to come together to perform that task on your behalf, right? So I think you will see, I would not call it a 10x scale, you will see multi scale coming in, because you now no longer need to actually call physical agents. You can call a lot of virtual agents, both on the credit underwriting side, on the risk management side, as well as on the collection side, right? Now, taking a step back, right? Today, if you look at the LLMs now, there is intense competition. We already have 5. You will see much more coming in. But if you look at the financial ecosystem today, unlike others, it's highly regulated, right? And people who are actually accessing and using the systems are also very technical in nature, right? So no generic solution to our mind on the agentic framework is really going to solve this for the banking ecosystem, right? So what you will start seeing is largely twofold. You will start building more and more on the co-pilot framework because your users are more technical. You are actually engaging with the credit team of banks, risk team of banks who are extremely technical themselves, right? So the framework might more evolve towards a co-pilot framework where the agent is actually going out and performing tasks. And in some of the more nuanced tasks, the agent is actually handing it over to the human, and then the human is actually handing it back to the agent, right? So you will start seeing that dynamic playing out. Already it is playing out, and you will start seeing that playing out at scale. So how have we tried to approach this? As I said, our view is SaaS is going to get smarter and smarter, and it's going to be very tougher if you don't really make that as a decision engine, right? So I think the overall evolution, if you look at next 1 year to 2 years, I think is going to be rapid. Static workflows will go away. It's no longer going to be about operating efficiency, right? So a lot of tooling we were using or a lot of SaaS products we were using as customers will find it more and more challenging if intelligence is not embedded at that point of time, right? So what is the design and hypothesis we see of the future is that standalone SaaS, you will see, getting much more smarter. If it is not getting smarter and is not taking decision, it will find it difficult to scale. So you will see much more embedded and integrated ecosystem where both sides of the network, which is the borrower side of the market as well as on the lender side of the market, they will come and talk to one common protocol, right? It's already happened in payments. Payments is far more simpler, compared to lending, because for the simple reason, you simply cannot standardize banks. So bank A is always going to be different from bank B because their cost of fund is going to be different. And because their cost of fund is different, their risk appetite is different, and their risk appetite is different, which means they will underwrite differently, right? So this obsession of standardizing bank A, bank B, bank C, to my mind, at least our personal and in-house view, is not going to happen, right? Now, in that context, how do you ensure that you're building an infrastructure which is allowing that interoperability to happen at the banking ecosystem, not for credit, but for customer access and customer onboarding, right? Credit will remain different, policies will remain different, right? And efficiency will come in more and more on underwriting as we think on more agentic, right? So what you will see is the network will get more homogenized, right? You will see what we call as the digital banking infrastructure, which is the SaaS layer, will become more and more intelligent, right? But what will be unique to a bank is largely going to be their own IP on how they want to underwrite, and what they want to underwrite is going to be the core sauce which will keep differentiating. In interest of time, I'll just, so this is what currently you see as the life cycle, right? I think people don't talk about collections in the same breath as you think of underwriting, right? So what happens today and what you have seen in the last 12, 18 months, that as credit cost on unsecured loans have gone up, the first thing we have done is we have had a knee-jerk reaction and we have put a stop, right? And if you have not put a stop, we have largely gone ahead and significantly tightened the overall criteria of how you will go and underwrite, right? But underwriting is only the starting point, right? If you're not going to build enough infrastructure on the side of collections, irrespective of how well you underwrite, right, you will still see default, because underwriting, as I said, is at the point of time. And the customer's actually life cycle is changing after you have given them credit, right? So the customer is going to change with every passing day after you have lended to them, right? So what happens here is that your balance of power has actually moved from the lender to the customer without the lender even knowing. So till you have lended, the balance of power remains with you. The moment money goes out of the bank, the balance of power actually moves to the customer, right? And 2 or 3 unique things, I think that's why we need to break the silos, and we need to ensure that your credit, your monitoring and collections is actually becoming a continuum. Otherwise, you will not be able to scale. I'll just give you a very small example, right? 2 things which to my mind are going to differentiate a credit infrastructure or a credit underwriting platform versus what you today see on any other marketplace or platform, right? So today, if you look at food delivery, you look at e-commerce, you take any other platform, right? There, the platform is always in control. So you pay, the order management starts, and the fulfillment actually concludes the moment the order is delivered, right? So you pick any sector. You pick e-commerce, you pick delivery, you pick anyone which is like rides, etc., right? Your order is only starting once a payment has been made. And it will always conclude with, your fulfillment will always conclude with delivery. Now let's take a step back and come back to what we are discussing. Here, your fulfillment actually is running 15 years, 16 years, if you have given a mortgage loan, right? So your fulfillment is actually moving 3 years, 6 years, 15 years. It's not going to coincide the moment you have actually transacted, right? Second, in credit, you are always at a point of no return. There is no concept of refund or return, right? So your margin of error is very, very low if you're not moving it from a static risk to dynamic risk, right? And that's where, when I largely talk about, some of the work we are doing, which I'll just spend 2 minutes largely on 2 key components, which to my mind is going to be the future. We have built, to my mind, what we call as the smart underwriter, right? Which is today working with some of the large private sector banks here, where they are partnering with the credit teams and the risk teams to take risk from being static to dynamic, which means that today, for one of the private sector banks, we actually generate roughly 60,000, 70,000 credit memos, right, every year now, right? And this is only on one part of the bank, by the way. This is only on what we call as corporate credit, mid-size, small-size, corporates which are actually working with the bank and partnering with the bank, right? So you're using a lot of generative AI, right? So the way you are actually building the vertical LLM, so you're taking some components from the larger LLMs, but you are actually training them in your own ecosystem, which means you're training them on all the CAM reports which has been historically written in the bank, right? And you're bringing the nuances of primary data which is directly coming to you from the customer, because you have covenant and you have rights from the customer. So you are getting data every month, you are getting data every quarter, and then you are also using a lot of public data and APIs, right, to get to decisioning, right? One point I'll again provocate, and this is our more in-house thinking. There is a lot of discussion around agentic AI. Our view is that agentic AI is much more around engineering than data, right? So the more APIs and information you are actually throwing in, right, the system is actually behaving very differently, which I will very, very briefly cover when I talk about the collections ecosystem, which is going to enable the credit underwriting ecosystem. This is what you see. I'll not spend much time, but what you are seeing is we are generating, as I said, thousands and millions of credit memos today, right, at a click of a button, right? And these are largely now sitting on supply chain value chains. These are sitting on corporate value chains. These are sitting on retail value chains, right? So your ability to write a credit memo at the point of transaction and your ability to rewrite the credit memo again and again, again and again, using AI is truly going to be transformational, which means that the credit team and the risk team are only and only spending time in most value additive parts. They are not spending time today in writing these memos, right? So I think, as I said, this is a start. It will get accelerated rapidly. The great thing is that our customers are regulated, which means that you need to deploy it locally. You need to train it locally, right? And I think that's where you will see Bank A, Bank B, Bank C continuing to differentiate in that unique context, right? So this, to my mind, is the future of what you will see on, to my mind, generative AI and agentic AI on underwriting. I think we are already operating at very large scale. We roughly do now close to 1.4 million odd CAMs a month. I'll skip this and more move to something which I wanted to just bring your attention on in interest of time. This is something which we are using on go lives. So today, if you look at on our retail lending platform, co-lending platform, this year we will do close to 6.5 crore retail loans. We process today around 87,000 odd retail loans a day, right? And now when we are taking a customer live, there is no role actually on implementation, because you are converting everything from a smart contract to agents, and then agents are actually going and fulfilling their task, right? One key piece, again, I'll leave it with all of you. Today, we are seeing the API ecosystem evolving. I think if you give it another 2 years, 3 years, you will see the agentic ecosystem evolving, where agents on behalf of partner A and partner B are going to negotiate and contracts and close contracts, right? So 2 years from now, when we meet, you will see even the API ecosystem moving away from being API to agentic, where agents will actually go out and conclude what you are seeing from the smart contract, right? So once a smart contract is generated, you don't need any human interface. So this is how the overall TAT is coming down. We are taking our clients live now in anywhere between 14 days to 20 days, which used to take anywhere between 2 to 3 months before you saw this infrastructure coming in. I'll just spend in interest of time, just 2 minutes, and I will wrap up, right? This is what today you see on collections. So today on collections, we manage roughly 5.6 odd crore customers a month, right? We have 28 crore customer touch points a month, right? We are the largest collection tech at scale today. Now, what we have built here is an orchestrator, right? It's an agentic AI orchestrator. So to give you a sense, on 5.6 crore customers, where we are currently running campaigns and managing it end-to-end, imagine the people behind it. Only 8 of them, right? So we have an 8-member team which is running the entire orchestrator, right? And our volumes have gone up from being 28 lakhs 18 months back to 5.6 crores today, right? And by end of the year, we'll be roughly at around 6 odd crore retail loan collections a month. And the way it does is that the moment I get data from banks, my super bot wakes up in the morning and then calls multiple agents from the ecosystem, right? Right from your campaign management to campaign orchestration. It calls agent on the digital infrastructure, which digital infrastructure you use, whether it is going to be email, SMS, WhatsApp. And then if it is not resolved, how do I call my agents on the bot, which is a two-way bot, to engage with the customer for the customer to pay? And if the bot is not able to resolve, it is at every stage passing on the last disposition to the next agent, which means that the agent is passing on to the human agent at the call center, and the call center is actually calling the right agent to make that call. And if the call center agent is not able to resolve, it goes to the agency, and the agency then decides which agent on the ground this particular loan should get allocated, right? So in interest of time, I will end here that this, to my mind, is a classic scale of agentic AI operating at scale, because today we have multiple APIs coming in. And the more APIs I am throwing to the agent, which is about bounce, which is about litigation, which is about your entire reposition coming from Vahan. So the moment you are actually throwing APIs to the smart bot, the bot actually responds very differently, right? And we have seen very classic case, the moment we added the reposition data, the same bot was responding very differently, right? So this, to my mind, is going to be the future of collections, right? The collections is going to change more and more and will become agentic. You will see a lot of virtual agents being called and physical agents being assisted by the virtual agents. That will be the future. And if this ecosystem scales, your credit ecosystem will definitely scale and deepen. Thank you so much.
Can we have a round of applause for Mr. Gaurav Kumar one more time? And with that, we're open to take one question in the interest of time. Does anybody have any question or any thought or experience that they'd like to share with our speaker right here? Anyone? Let's keep this as an open forum. Let's keep this as a two-way conversation. Yes, sir. Can we please pass the mic here? Can you please on the mic here?
Hello. Yeah. So you had a slide on the co-lending. So my question is on co-lending. So despite all the efforts by the RBI and everyone else over the last few years, I think co-lending is still not picked up to the extent it was expected. So what is that stopping? It is the technology. It is the confusion of the risk of underwriting between the banks and the NBFCs, or what exactly? And what are the changes which are expected to happen? Because I think some committee has also been organized. So I don't know if you have the part of that committee or what. So if you can elaborate more on that point. Thank you.
That's a great question. I think in co-lending, what we have seen is 2 points. I'll leave it with you why it is scaling now. Just to leave it with you, last year, the entire co-lending market was around 90,000 crores, right? And this year, the co-lending market is expected to be around 1.6 to 1.7 lakh crores, right? Now, 2 parts to your question, where it is scaling and where it is not scaling. It is scaling largely on secured, right? So large part of the co-lending volumes are largely coming on mortgage, it's coming on secured SME, it's coming on vehicle. Where it is not scaling is definitely on unsecured, right? And it's largely, again, boils down to, risk appetite and how banks wants to do it. Because at this stage, the predominant role which has been taken in co-lending has been by the large public sector banks, and followed by large private sector banks because of priority sector, right? So you will see a lot of scale coming on co-lending. What we are also seeing is there is a lot of scale coming on what we don't call it co-lending, but partnership lending, which is 100-0, right? Where banks are partnering with very large distributed platforms like PhonePays, GPays, Ola's, Creds of the world, where the customer sitting on their landing zone is being brought into the banking ecosystem, right? That is evolving very, very quickly, right? So we see a lot of scale coming in. As I was sharing with you, on that platform, we do roughly around 65,000 loans a day, right? To your last point, I think RBI has already given a lot of clarity and guidance, right? So you will see the ecosystem scaling. One piece, why it was not scaling and it will scale is because banks were trying to do integration one-on-one, and the one-to-one integration is not something which will scale, right? So I think that's where you will see scale coming in, because technology has solved for it, and there is also now high degree of clarity.
Hi, if I can take one question, if it's possible.
Okay, last question.
Yeah. Hi, sir. This is Nikhil from INR Bonds. So my query is if you take a unsecured personal loans or MFIs, for example, where even now most of these NBFCs are dependent on the ground persons to collect the loans and make sure that the delinquencies are lower. So if you're saying the agent's gonna take over the entire collections, do you see these sectors, they might not go through any credit down cycle? I mean, do you see sometime in future, these guys don't have to dependent on thousands of ground level people to do the collections and all?
I think 2 points to that. I think one, if you look at right from your pre-due, right, to Bucket X, I think it will largely go digital, right? Sometimes the last mile, because of the nature of the loan, whether it is a vehicle loan or in this case what you are mentioning, I think the low ticket size loans anyways will find it more and more difficult, because the most expensive asset in the value chain is the human agent on the ground. Right? So human agent on the ground in the long term will make the small ticket size loans unviable as far as collections is concerned, right? So that's the direction it will go. And as in the very near term, 0 to, I would say, 60 is already moving digital, right? So that's what you will see now even in asset classes which are low value ticket size on collections.
But if you see the US payday loans, okay.
Thank you.
Thank you. Thank you so much. Can we have a louder round of applause one more time for Mr. Gaurav Kumar? May I please invite on stage back Mr. Shashank Shekhar to please present a memento to Mr. Gaurav Kumar for that fantastic presentation. Thank you for sharing your insights on what the future and the picture looks beyond silos and how we can really create an integrated credit framework for tomorrow's financial ecosystem. Thank you. Thank you so much.